Hello, everybody. Today we're gonna talk about distribution of income and types of taxes, made by me, Julian, Sunny, Cal, and Derek. This is our table of content. The first thing we're gonna talk about is going to be unfair distribution of income and wealth. Then we're gonna go to the Lorenz curve. Then we're going to measuring income, and lastly, the different types of taxes. So, unfair distribution of income and wealth. Income and wealth distribution are very common to be unequal in the modern economy. Income inequality are unequal distribution of income among individuals or households. Wealth inequality are unequal distributions of assets, for example, properties, investments, and savings. The concentration of income and wealth in the hands of a few can lead to various social and political consequences. And a few common income distribution measures are the Gini coefficient and the Lorenz curve.
The Lorenz curve. The Lorenz curve is a visual reflection of the economic realities within a society. So the horizontal axis represents the population in ascending order of income, from the poorest on the left to the richest on the right. Vertical axis represents the proportion of total income earned by the corresponding population percentage on the horizontal axis. Um, so let's look at the diagram on the right. The green line, equal wealth. This curve represents a situation of perfect equality where each percent of the population earns the same percent of total income. And the orange line, unequal wealth. This curve shows a scenario where wealth is somewhat unequally distributed. And finally, the red line, very unequal wealth. This curve depicts a more extreme case of inequality. So the degree of curvature from the line of equality indicates the level of inequality. A larger gap suggests higher inequality.
Now let's look at measuring income distribution and specifically the Gini coefficient. What is the Gini coefficient? The Gini coefficient puts the concept of income distribution into a numeric value that can be calculated by looking at the Lorenz curve, which we just previously discussed. A Gini coefficient with a value of 1 represents complete income inequality, and the value of 0 represents complete equality. So the Gini coefficient shows us how far the Lorenz curve sits from the line of equality. It does this by comparing the areas of A and B, which we can see from the diagram on the right side. The equation for the Gini coefficient is the area of the area of A divided by the area of A and B combined. Now let's look at an example where income is perfectly distributed. So in that case, the Lorenz curve will equal the line of equality, which means the area of A will be 0. And that leaves the area of B to be the complete triangle underneath the line of equality, which means that is 1. And if we put it into the equation, that is 0 divided by 0 plus 1. And that gives us 0. And we know a value of 0 means that it is completely equal.
Now on to the types of taxes. There are 4 types of taxes: income, property, sales, and excise taxes. Income tax, as the name suggests, is the tax imposed on the income of a person or firm. And there are three types of taxes: regressive, proportional, or progressive. Regressive tax means that lower income people pay a higher tax rate. Proportional means that everyone pays the same rate, and progressive means that higher income people pay a higher rate, which is the most common type of income tax used today. There is also a concept known as the marginal tax rate, which is the tax rate applied to an additional dollar of taxable income that is earned. And using this, people can make decisions regarding how they, for example, earn money, like choosing a job over another job. Now, there is one thing that needs to be clarified. If a $10 tax is imposed on everyone, this tax is regressive because $10 for a lower income person will take up a higher percentage of their income compared to a person with a higher income. That $10 will take up a lesser percentage. Moving on to property tax, again, as the name suggests, property tax is the tax paid on assets and is usually imposed on businesses and personal property. How a property tax is determined is a government official would determine the property's value and then a tax rate is applied, usually a percentage. And since a property ownership is higher among higher income households, this property tax is usually considered to be progressive. Sales tax is the tax placed on firms as a percentage of their sales and is generally applied to retail sales, like when you're buying things at a store. Though sometimes some items can be exempt from sales tax. For example, sometimes food or medicine are exempt. And since lower income people put a larger portion of income into items with sales taxes are usually considered to be regressive. Finally, excise taxes. These are taxes placed on specific items and can either be due to the government wanting to discourage the consumption of that item, or it can be used as a benefits received tax. So discourage consumption, for example, cigarettes and alcohol. You don't want people to smoke because it's not good for their health. And for benefits received taxes, these are basically taxes that are taken that go back into the industry. So for example, gasoline is taxed for maintaining highways. There is another concept called tax incidence analysis, which is basically finding who the burden of the tax rests upon. Like when you pay for an item at a store, even if it says sales tax, for example, on the receipt, it is ultimately the store who pays that tax to the government. So if tax increases the price of a product or service, then that means the burden of that tax is on the consumers. If a tax reduces wages or the price for some factor of production, then the burden is on the owners of the factors of production. And if the tax doesn't change the price of the product nor the price of the factors, then the burden is on the owner of the firm or the owner of the capital. And we can look at an example for the burdens of excise taxes. So if you look at the 4 graphs here, these show elasticity and the basically comparison of elasticity with who is more responsible for the burden of a tax. So sellers bear more burden when supply is relatively inelastic or demand is relatively elastic. So you could see this in panel B, relatively inelastic supply, and relatively elastic demand in panel C. So panel B and panel C shows that the producer takes up more of the burden for the tax. You can see that more of the tax is under the original price, so that is paid for more by the seller. And the complete opposite is true for buyers. So buyers bear more burden when supply is relatively elastic or when demand is relatively elastic. You see that in panel A and panel D, where there is more of the tax is above the original price. So that means the consumer pays more.
Thanks for watching our presentation, and we wish you have a nice rest of your day. Bye bye.